And then, on top of that, you've got the grid that is old and it needs to be replaced in some parts. It needs to be repaired in other parts, and it needs to be hardened and made more resilient. It's very easy to buy when others are selling, when there's blood in the streets. The hard part for me is not getting too excited too early in the sell-off. Bernstein put out a note at current build rates. That's 10 years of data center build just from announced data center.
All right, folks, welcome to Investing for Beginners podcast. We are excited to have John Rotonti back to talk to us today. John is the portfolio manager at Bastion Fiduciary. Congrats on the new gig. And we're excited to talk to you today, John.
Thank you. Always excited to talk to you and your listeners. Thanks for having me back on. I appreciate it.
Yeah, you're welcome. It's our pleasure. The last time we had you on, we talked about valuation and ROIC, and that was a huge hit. And I thought maybe we could talk a little bit about some things like portfolio management and stuff, since that's kind of what you're doing now. This will definitely fall into your wheelhouse. So I guess maybe let's start with an easy one. Like, when you're thinking about building a portfolio, where do you start?
Thanks for the question. So just really quickly, our name is still Islamorada Investment Management.
Sorry.
No, it's not a problem. It will change to Bastion very, very soon.
Okay.
But we're in the final steps of that process. So the portfolio currently is about 30 stocks. It is domestic only, and we define domestic as reporting in US dollars and trading on a US exchange. So there are some companies in the portfolio that are headquartered in Ireland for like tax purposes. It's nonsense, really. They report in US dollars. They're US companies. All of their main headquarters are really US based. Now, they may have global business. They may generate their revenues all over the world, but domestic, long only, roughly 30 stocks. The name of the strategy is industrials, infrastructure, and housing related. Very much broader, though, than the name would suggest. Industrials is everything from, little tool companies to large manufacturers, transportation, everything in between. Infrastructure, the G20 in 2017 estimated that the world needs $97 trillion in infrastructure spend by 2040, $97 trillion. That report in 2017 didn't mention AI once. So I guess you could assume that AI is gravy on top of 97 trillion. My point is AI is large and growing and getting rightly so, a lot of attention right now, but AI is one subcategory of broader global infrastructure. When I think of infrastructure, I think of everything from the electrification of everything all the way down to water, and then all the way down to infrastructure. So I've got companies like Visa in the portfolio. People think Visa's a fintech. And I say, yeah, but it's got 10 million route miles of telecommunication infrastructure built into the ground around the world. Infrastructure. We've got a company like Amazon. Amazon is, I think, I don't look at these categorizations, but I think it's consumer discretionary. I think that's how the indexes categorize it. I think of it as tech infrastructure. If you think about their global data center footprint, that's clearly infrastructure. If you think about, they have custom silicon, custom semiconductors, that's infrastructure layer. They have their entire e-commerce fulfillment, supply chain fulfillment centers. They are building same-day delivery centers in rural areas right now, all infrastructure. The vans, the trucks, the drones, the satellites that they're going to launch into space this year, they're going to start launching them. So just another example of market may categorize it as consumer discretionary, and e-commerce is still a large and very big part of their business. But when I unwrap that onion, I see infrastructure there. Housing related is just as broad as infrastructure. It's everything from land developers to home builders to building supply and material companies supplying everything from the roofing to the siding, to the brick, to the insulation, to the flooring, to the cabinetry, to the paint, coatings, different wrappings, fireproofing and waterproofing wrapping, to third-party installers. Believe it or not, the builders, the home builders, sometimes contract out the installation of things like insulation, shower doors, gutters, fireproofing, waterproofing. It goes on and on. And then once the homeowner, the family is in the house, then you have service companies like pest control, plumbing, pool maintenance, landscaping. You have banks that give mortgage loans. You have insurance companies that provide home insurance, flood insurance, companies that allow homeowners to turn their homes into income generating assets, and so this is a very, I think, broad and diversified portfolio. And then right now I'm about 26% cash. That's partly because the portfolio is only about 5 or 6 weeks old right now. And so it's not completely fully built out, but also cash is a residual of the process, strict selection process. I will not compromise on business and managerial quality. That's rule number one for me. I try to buy these high quality, profitable growth businesses at attractive valuations. And we can talk about that if you want. But the one thing I will not sacrifice is quality. And, right now, even though a lot of stuff has sort of re-rated to lower multiples, when I launched the portfolio, I did not see a lot of screaming bargains in the quality space. And so cash is a residual of the process and the selection criteria. Did I answer the question about how I think about a portfolio?
Oh yeah. Yeah, for sure. Yeah, for sure. So the 97 trillion, I think 90 of that is probably needs to be spent in Brazil after being there not too long ago. They need some help.
I tell you, New Orleans will put up a fight. There's an Instagram, and I think it may be on TikTok too, channel of just potholes in New Orleans roads. And it's absolutely hilarious because it's so true. One day there will be like a 2, 3, maybe 4-inch pothole, and a week later, the city has just put like one of these orange cones in it because now it's a foot deep and 3 feet wide. It's a completely different hole a week later, and then literally 3 weeks later, it's a hot tub. Because it rains so much here, and so it's like 5 feet wide, 3 feet deep. It's collecting water, and then next thing you know, you can literally find it'll turn into a sinkhole or a car's going to be in it. And so you could find this channel on Instagram. It's crazy. I mean, I love my city, but yeah, we're going to need some of those dollars too.
Okay, all right,
yeah.
Fair enough.
Yeah,
fair enough.
But the portfolio, I don't think I'm sure it won't have 26% cash long term. I don't think I'll be fully invested at all times though. I'm comfortable running with 10 to 15%. It's how I've done it for 20 years. I like having some cash so that when there is a real opportunity, I'm talking broad market sell-offs here, when all correlations go to 1 and you can buy anything you want on sale pretty much because everything falls, or that's a broad market sell-off. Or the second best opportunity to buy, in my opinion, is when you get an industry specific sell-off for whatever reason, and everything in one vertical goes down by a lot and gaps down by a lot. And then the third time I like to buy is when some company, either in the portfolio or high on the watch list, gets hit by earnings or something like that. So that's just an individual opportunity. But having cash allows you to fund that purchase without having to sell something else that you love that's just temporarily depressed because everything is down. I don't want to ever be in a situation where I have to sell something that I love that I think has a 10-year runway of per share growth, and it's just temporarily depressed. I don't want to have to trim it at a discount to what I think it's worth just to buy something else that I really want in the portfolio. So I like having some cash. That's unconventional based on, I'm not organized as a mutual fund. These are separately managed accounts. But if you look at mutual funds right now, based on a Bank of America fund manager survey that came out maybe 3 weeks ago or so, fund managers like at the time 1.5% cash. They were basically fully invested, and they were more invested than they had been in quite some time based on the survey. And so I think that's a little bit unconventional, averaging 10 to 15% cash.
I guess there's tax implications too if you're having to sell a winner.
Absolutely. Want to be smart about trying to minimize taxes. This is not a tax efficient strategy. It's not marketed as that, but I'm invested in it, and I want to be smart about that for sure. Yeah, for sure.
So there's a lot of things you mentioned that are really interesting. One that kind of sticks out to me today, just because of what we're seeing with tariffs, is you mentioned industry-wide sell-offs. And that can be hard sometimes because there will be narratives, and obviously there's always a reason why an industry is selling off. So how do you approach that for yourself? Just to use tariffs as an easy example, since it's current. Not to say that there's opportunity there now, but as an example, someone might quip, "Oh, how could you buy into a tariff downturn? Obviously, profit margins are going to get hit." Yada yada yada. So, like, how do you approach industry-wide sell-offs and be the contrarian? Because it's not always an easy thing to do.
So, emotionally, for me, it's very easy to buy when others are selling, when there's blood in the streets. I'm comfortable doing that. The hard part for me is not getting too excited too early in the sell-off. A mistake that I have made in the past. When these sell-offs are happening, I want to be aggressive and I want to be active, but I want to sort of parse it out over time, because when the market breaks, and I'm using the word break as not a blow up, but when momentum turns down, when sentiment clearly turns down, that doesn't always go away very quickly. It can last for weeks or months or a quarter or two. And so I want to make sure that I have the cash throughout this process in case things keep starting to turn down. And so I will just slowly buy into things. I would say in 80% of the scenarios, I'm adding to stuff I already own. I love my stocks. I said roughly 30. I've got a watch list of another 50 that I've done research on, but really 20 or 30 of those 50 that are at the top of that watch list that I'm just waiting to buy. And so my universe is pretty small right now. One person, I don't have an analyst. I may down the road. And that's something else we could talk about, is how I would use an analyst. But my universe of stocks that I really want to own is maybe 60 or 70 right now. But these are what I consider to be the highest quality, profitable growth, long duration. If there's one thing I could stress to anyone that's listening or anyone that wants to talk to me, it's the rate of growth is not as important to me as the duration of growth. I really want profitable growth, per share growth, extended over as long of a time period as I can find it. And based on my analysis, I believe that the company is sort of early in a long duration profit cycle. Now, I said rate of growth is not as important as the duration of growth, as long as the valuation is reasonable. If something's trading at 30 or 40 times earnings and I'm considering buying it, I have to believe it's growing pretty quickly and for a long duration, so that it grows into that PE, relatively quickly. And so that's why I throw out numbers like this 97 trillion estimated in global infrastructure spend by 2040. I don't put a whole lot of credence in that $97 trillion number, because it's so almost mind-boggling large, right? But what I do believe, based on everything I've read and everyone I've spoken to, is that the number is going to be big. I don't know if it's going to be 97 trillion, but it's going to be tens of trillions, and it's going to happen over a really long time. And so I want companies that are positioned to profitably grow from these long duration trends for a long time. You know, another one is Goldman Sachs estimates that the electrical grid in the US is anywhere from 50 to 70 years old, depending on what part of the country you're in, and that it would take 40 years just to replace half of the grid, 80 years to replace the whole grid.
Wow.
And they estimate in their sort of base case that we need $4 trillion in US spend, US electrical grid by 2040 or 2045. I don't remember. But another example of, we're talking 4 trillion over the next 20 years or so.
Mm-hmm.
So I'm really trying to find things that, you know, are positioned to benefit from that. There have been $350 or so billion in data center investments announced, 350 billion at current build rates. Bernstein put out a note at current build rates. That's 10 years of data center build just from announced data centers. Apple just announced, Tim Cook and Apple just announced 500 billion over the next 5 years in US investment. Stargate, which is, you know, a consortium joint venture of OpenAI, SoftBank, and Oracle, announced 500 billion US investment over the next 4 years. You got Meta, said they're building a data center that would take up a significant portion of Manhattan. Trying to wrap your head around that. A data center that's
That
significant, yeah, that big, 200 billion. They're in talks to borrow 35 billion from Apollo. I mean, massive numbers are getting thrown out there. When you think about a data center, this is just data center. And like I said, data centers are a tiny sliver. It's what everyone's talking about, and it's what's driving the market right now, both on the way up and now on the way down, is the AI trade. But it's a tiny sliver of global infrastructure spend. But the numbers that are getting thrown around are massive, and a data center that is announced, right? There's a 3 or 4 year pipeline of work that needs to go into this before it's done. So like these companies, the hyperscalers will talk to utility providers saying, hey, we think we're going to build some data centers in this region. So the utilities will start getting that power and energy ready, that load ready, 2 years before the data center is like shovel and ground, right? And then, you know, it takes, I don't know, 12 to 24 months to build a data center. So you're looking at like 3 years before one of these things that's announced is really ready to go.
Mm-hmm.
2 to 3 years. And so these are, I think these are long duration trends. And when I talk about quality, I'm talking about business quality and managerial quality. I'm talking about quantitative and qualitative. And really what it all boils down to, you're talking about a funnel of everything, all the research that comes down that funnel, it's the duration and the rate, but really the duration of the per share growth. And I just try to buy them well and then just hold them. But that's what I do, is I just try to buy slowly. I try to average down into these. I say average down because my stocks are down. I try to average down into these things slowly. A prospect called me, or we spoke like 2 weeks ago, and he was reading some literature that I put out that said it's industrials and infrastructure and housing related. And he asked me, what are the chances all three could be down at the same time? Well, I said the chance is pretty good because they're all down for me right now. But this doesn't bother me. I believe in, I have conviction, and I believe in my valuations. Now I'm going to be wrong, but until I determine I'm wrong, I'm comfortable waiting this out and slowly averaging down. And to the tariff question specifically, some companies are more exposed than others. I have some companies that have virtually zero direct exposure to tariffs because they're 100% U.S. and they source all of their material from the U.S. or they source very little from outside of the U.S. Now, there's probably indirect exposures because supply chains are going to get all jacked up. Inflation is going to. This is if this stuff really happens. They're already talking about rolling some of the stuff back, like literally in a day. The administration is talking about rolling some of these stuff back, some of these tariffs back. And so I really don't know how much of the actual tariffs are going to take place. Now, investor psychology wise, this sort of back and forth and this flip flop, this is not a political statement, but I think it adds another layer of uncertainty to the market, and markets don't like uncertainty. And so even if the tariffs get rolled back and it ends up being a nothing burger, it may not be a nothing burger just because there's that uncertainty in the market. And investor psychology is what drives markets in the short term. And that's what drives these re-ratings, PEs up or down in the short term. It's just really sentiment and investor psychology.
So how do you determine duration?
Thank you. That was gonna be my next question.
Obviously a super easy answer, right?
Well, it's on a case by case basis. Let's give a really easy example. Utilities, regulated utilities are allowed to generate a regulated return on equity. And that return on equity drives a certain level of earnings per share growth. There's the formula. I know you guys like math. EPS equals ROE times 1 minus the dividend payout ratio, right? Now, just caution, I would use average ROE in that equation because ROE could be high or low for a one-time reason, 1 year or another. But ROEs drive earnings per share. Historically, we had 20 years of no load growth in the U.S. Really no increase in electricity demand. It was flat. It was stable, and these earnings per shares were growing 4, 5, 6, 7% per year for electricities on average across the group. And now for the first time, but that's really long duration growth because the regulators say as long as you invest in your grid, in your transmission lines, in your poles, in your equipment to maintain good coverage for the population, then we're going to let you slowly grow your earnings per share over time. That's really, it's a regulated growth. It's really long growth. And it's as far as I can tell, as far as the eye can see, because the only way that stops happening is if they stop investing. As long as they invest, the regulators allow them to earn something. But now we have, for the first time in 2 decades, the expectation of power demand growth, of load growth. So from being flat for the last 20 years to growing, I'm reading estimates of 1 to 3%. Let's say 1.5%. That's still a step change. It's still a step change. And so now maybe you've got utilities that can grow earnings per share from 4 to 6% before. Maybe we're at 6 to 8%. And maybe in some cases as high as 9 to 10%, depending on the part of the country they're in, population growth, migration, all of these things. With the rate cases, what the regulators allow in different parts of the country. It's just on a case-by-case basis. But what I look at and how I do it is I try to build a revenue ladder. I try to ask myself how fast I think the company can grow over the next 5 years. So I do everything on a 5-year basis, everything. And what it boils down to, I'll get back to the revenue in a second. What it boils down to is I bucket each of my portfolio holdings into one of basically 3 buckets. The first bucket is I think the company can grow earnings per share average per year, annualized over the next 5 years, 7 to 10%. And the second bucket is roughly 10 to 15%. And the third bucket is roughly 15 to 20% plus. So the question is why 7% on the low end? Because 7% is a 10-year double. And I want to get a 10-year double minimum. That's what I'm looking for. And so what I do is I don't try to say I think so-and-so company can grow at 13%. I work in very wide error bands and very wide ranges. I say I say XYZ company can grow 10 to 15%. And I buy when I think I can get an attractive return based on the low end of that range. So I want to expect to earn at least 12% across the portfolio, 12% annualized across the portfolio. I'm sort of trying to underwrite to based on my analysis, based on what I think will happen. I'll be wrong in some cases. I want to buy when I think I can generate 12% total shareholder return from a stock on the low end of my range. So if I think a company can grow 10% and it's got a 2% dividend yield, that's 12% total shareholder return with no multiple expansion. That's kind of how I think about it. And then after a year has passed, I just roll everything forward another 5 years, and I ask myself literally, do I think this company can still grow in the 10 to 15% range? And maybe the answer is yes. I think usually the answer is probably yes. In some cases, though, something happened and I say, no, I think it's actually going to be able to grow in the 15 to 20% range. An acceleration of growth. That would be great. But in some cases, it's actually a deceleration. And I think, no, I need to drop this down to the 7 to 10% bucket. And then I ask myself if I still want to own it or if I want to trim it. But how do I get through the duration? It's, I start at revenue growth, just like anyone. And I ask myself, how fast do I think you can grow revenue? And I break it down. Okay. GDP is growing 2 or 3%. I think this industry has historically grown at GDP plus 1 or 2. And why do I think it can continue to grow forward faster than GDP growth? So if GDP is 2 to 3, and this industry has historically grown 1 to 2% above that, right? Then we're at 3 to 4. And then maybe above market growth came from market share gains. But maybe the company is also rolling up a fragmented industry. And so it makes acquisitions every year, right? And 2% of growth comes from acquisitions. So now from 3 to 4, you add 2, and you're now at, what are we at? 5 to 6 or something, 5 to 6. So that's my revenue. I'm making this up. That's my revenue growth. But it has to be supported by my research, by third-party data. What is Gartner estimating the industry can grow at, for example? How fast has the company grown historically? What are the demand drivers driving that growth? Has management given any long-term guidance, 3 to 5 year guidance, which I will incorporate to some degree? So we're at, I don't know where we were, 5 to 6% growth. And then I ask myself about margin expansion. Is there any margin expansion opportunity? And if so, where is it coming from? Coming from gross margin line, COGS? Is coming from below the gross margin line, sort of operating expenses being taken out in some way? Is there a mix shift in the business? Is the business going to be selling more products that are higher margin than in the past? Had they divested lower margin businesses? Are they buying higher margin businesses? There's lots of reasons that you could think margins would expand, but I have to have conviction in why I think margins will expand. So maybe I think, 5 to 6% top line growth. Maybe I think over 5 years, we get 100 basis points of margin expansion. In some cases, I think we could get 200, 300 basis points, but 100 basis points. So now we're at 6 to 7% operating income growth. And then, maybe the company's buying back 2% of the shares annually. And that gets you to 8 or 9% or so, maybe 10% earnings per share growth. But I have to have conviction in each step of that process. And this is not a detailed model that I'm building. This is just, I think, knowing my companies, knowing my industry, and just doing some quick back of the envelope math, quick Excel math, and then every year asking myself, as 1 year passes, do I think it can maintain these numbers? Or do I think they're going to accelerate or decelerate? And I try to buy at the low end of that range. When I think the low end of that range will provide me the expected required rate of return that I'm looking for.
I love that.
Yeah. Can you give an example? Ideally, it would be something that's well known, but if it's not, that's okay. But a stock that moved from one bucket to another, and what were the things that made you want to move that stock from one bucket to another in your mind?
I mean, yeah. I don't have any utilities in the portfolio right now, but that would be an example of, going from stable demand to actually having some load growth demand for the first time in 20 years. And that's coming from basically the electrification of everything. EVs are a big part of that, but you're also seeing electrification of the home with appliances. You're seeing billboards are now electric. Everything, the accessories and jewelry that we put on our body is now electric. You can buy the Oura Ring. Sunglasses now have Meta's glasses and Snapchat's glasses, they all have electronics. So it's not just the electrification of everything, it's the electronification of everything and the electrification of everything. But all these devices that we use, everything is becoming electrified. And then, on top of that, you've got the grid that is old and it needs to be replaced in some parts. It needs to be repaired in other parts, and it needs to be hardened and made more resilient in other parts of the country because of extreme weather, fires, hurricanes. I live in New Orleans. We get just battered by these hurricanes. And one way to do that is to underground everything. It's an extremely expensive undertaking, infrastructure project. So the grid updating, data centers, which we've talked about. So there's a lot of companies that sell electrical components into the data centers. Everything from sensors and wiring, fiber optic and copper, but really fiber optic, a variety of sensors, obviously semiconductors, but I'm not even talking about semiconductors right now, but the server racks that go into these things, cooling equipment, even liquid cooling equipment, also traditional air-cooled HVAC equipment. All of these things were not going into AI data centers sort of pre-2023. The AI data center really picked up when I think NVIDIA came out with the A100, and that sort of changed the game and the structure of how some of these AI data centers are built separate from traditional cloud data centers. Traditional cloud data centers do a lot of data storage and app hosting and data analytics and things like that. But these training and these inferencing data centers are a beast, a different type of beast. I'm saying they're all beasts. And so there's electrical component companies that were growing mid to high single digit earning per share prior to 2023 that are now growing 10 to 20%. You have HVAC companies that traditionally were doing a lot of residential air conditioning and heating and small commercial, like something that goes on a McDonald's or Domino's or a Best Buy. But now these HVAC companies are building what are called applied systems. They're highly customized for one project. They're customized for one project. Taiwan Semiconductor yesterday announced $100 billion in U.S. investment above the $65 billion they already announced. Well, they've got rooms in these in their foundries that you can't have a particle of dust, not a speck of dust. These clean rooms, and so you think about the HVAC systems that need to be put into these things and how they pump stuff out and how complicated they are. So these companies are building these highly customized applied systems that go into hospitals, foundries, data centers now, skyscrapers. And because they are customized for just this one project, you can't buy repair replacement parts off the shelf because they don't exist. It's just a customized project. And so these massive machines, really highly complicated, massive applied machines, they have service revenue that is equal to 8 to 10 times the cost of the initial machine. And this service revenue that is equal to 8 to 10 times the cost of the initial machine is much higher margin. A lot of this is on the newer side of the story. And so these are just examples when you see not only revenue growth accelerating, but the revenue is coming in at higher margin. I'm trying not to mention too many names, I'm not supposed to, but I've talked about GE Vernova on podcast before. It's a brand new company to the public, to the public markets. It spun off from GE. GE spun off GE Vernova and GE Healthcare, GE Medical in 2024. And now GE changed its name to GE Aerospace, and now you've got GE Vernova and GE Healthcare. Well, GE Vernova is the largest, most scaled provider of gas turbines in the world. High combine, massive gas turbines in the world. And there's a 4 or 5 year wait for these. They're completely sold out. But there's massive demand for these gas turbines because they help power a variety of things, including data centers. And so GE Vernova has now announced joint ventures with the biggest energy and technology companies in the world, including Amazon Web Services, NextEra, Chevron, and NRG. And it's my expectation that they're just going to continue to announce more and more of these joint ventures and partnerships, because there's massive demand for these gas turbines. And so what these customers are doing is they're reserving slots or spots for 2029, for 4 or 5 years down the road. You can imagine if there's no supply currently, because they're sold out, and really high demand, well, there's a lot of pricing power. That's basic econ, first day of Econ 101, supply demand dynamics. And so the backlog, of which they have 119 billion in backlog, total backlog, it's a lot. The backlog in the out years is much higher margin than the current products they're providing. There's 3 or 4 other reasons that I believe, based on my analysis, that GE Vernova's margins are going to increase pretty materially over the next 5 years. But that's just one reason, and maybe the main reason, is that out year backlog, 4 or 5 years out, is much higher margin because of the pricing power. And so that's just an example of how I get confidence in the duration, in the growth, the revenue growth, in the margin expansion opportunity, and then in the capital allocation, how it all ends up as per share, earnings per share, free cash flow per share. By the way, some of the other reasons is because they've got GE Vernova's operating system, like the Danaher system, and all these companies have these systems. Well, they have a great system of taking costs and efficiencies out across the company, and they give you case studies about how they do this at different factories around the world. Steve Angel is the chairman of GE Vernova. Steve Angel is on my Mount Rushmore of CEOs, literally. He was the CEO of Praxair, and he led the merger of Praxair and Linde. They changed their name to Linde. We own Linde in the portfolio. I have to say that. Linde it's a global oligopoly, industrial gas company, and there's only 2 other players at scale. I think these 3 players have 80 or 85% of the global market for industrial gases, and industrial gas is earning an incredible business with truly incredible economics. Well, Steve Angel's the chairman of GE Vernova. I mean, if you look at their slides, if you look at their proxy on the management and the board, it's just outstanding. And so they have this operating system that is taking costs out. That's another place of margin improvement. They have a wind business, a wind turbine business, and blade business, and servicing business that is losing money right now. So it's a negative margin. And they're working through about 3 billion-ish of negative margin business. They priced it at negative margin. So when they work through that, and I think they'll finish that backlog in 2027-ish. When they work through that negative margin backlog, well, then the wind business becomes positive margin. So that's 3 reasons. That's all. You've got the pricing power on the end of that gas turbine backlog, much higher margin. You've got the working through the negative earning wind business, and that turning positive margin. You've got their operating system. And then maybe the 4th reason is, I mentioned 119 billion in backlog. Right now, the business is 50-50 product service, but 2/3 of the backlog is higher margin services. And so, 4 reasons. If it was 1 reason, I'd have less conviction, right? You asked me how I get conviction in the duration. If it was 1 reason, I had less conviction, but 4 reasons lining up. Boom, 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 boom. I could be wrong. I could be wrong on all 4, but what I believe now, based on what I know today, I have 4 reasons telling me that growth is going to be strong and margins are going to rise pretty materially over the next 5 years, and that the leadership knows what the heck they're doing.
I recommended the stock a couple of years ago. That's up pretty big. I want to share that with you so you can see the type of analysis that I do for paid subscribers. Download it for free at stockwriteup.com.
So who else is on your Mount Rushmore of CEOs? Because frankly, I had never heard of Steve Angel before. So I actually made a note. Okay, go learn about this guy. So who else would be on your Mount Rushmore?
Um,
Put your feet
I
to
mean,
the fire.
no. I'm just thinking about what companies I can mention right now, because I'm not supposed to mention too many. But I would say that this is also going to be controversial. I would say that Tim Cook, not in the portfolio, but I would say that I think Tim Cook was the perfect CEO for where Apple was in its corporate life cycle at the time. The reason I say it's going to be controversial is because there's a narrative out there, which partly true, that Apple has not innovated to the extent that the other mega cap tech companies have. And there's a level of truth to that. But if you look at the consistency of the free cash flow generation and their sort of hybrid CapEx, they don't spend as much on CapEx as these other people do. And that flows through to much stronger free cash flow generation. And what they've done with the capital allocation and how basically no growth on the top line or very, low single digit growth has resulted in pretty impressive per share growth, earnings per share growth. I don't think he gets enough credit, and to take a company that big and grow it at a per share basis the way he does and demand it. And the balance sheet is bigger than the balance sheets of countries GDP. It's
Right.
insane. And to manage it in the way that he has, I think books should be written about it. I really do. I know this is controversial, and it's going to be the first company to return $1 trillion of capital to shareholders. Like, not in the too distant future.
Mm.
It's returned over 500 billion, well over 500 billion in the last decade. Like, in the not too distant future, 4 or 5 years or something like that, it will be the first company to return a cumulative $1 trillion to shareholders. And whatever he's doing is working because it's maintaining this PE multiple of 30, which returns on invested capital, if you strip out the excess cash, are probably approaching 100%, somewhere around there. And when he took it over, I don't know what the PE was specifically when he took it over, but during his time, during his early years in leadership, it average PE was a below market multiple of 15.
Mm-hmm.
And it traded down to as low as 9 or 10. Buffett was buying at some point at 9 in 2016, 9 or 10 times earnings. But its average multiple was 15, and he doubled the average multiple, and it's held at 30. So he's doing something. He's doing something right. But yeah, I don't know if he's on the Mount Rushmore, but he's on the honorable mention list. I think for sure.
Mm.
A lot of big CEOs are on my list. I think Jamie Dimon's on my list. Once again, I don't think his name gets thrown out there enough as a Mount Rushmore, but he runs the best bank in the country, maybe the world. And he's the most respected voice in finance and investing in markets outside of Buffett, arguably outside of Buffett. I think Buffett's on there. I definitely think Buffett's on there. So those are the ones that come to mind.
Yeah, those are certainly good choices for sure.
Yeah,
I would agree with all of those.
But duration, just back to the duration point, it also comes down to, I have to believe that the company has a moat that is sustainable, because the moat, and Andrew, I know you think about this and talk about this and share about this all the time, but the moat protects the economics of the business. And, if you think about the business as the economic castle and the business engine as the economic castle, well, the moat protects the castle. And the economic castle generates high returns on invested capital if it's a high quality business. The moat doesn't generate high returns on invested capital in and of itself. The moat protects the high returns on invested capital. And as I know y'all know, operating income growth is equal to the return on invested capital multiplied by the reinvestment rate. And so I have to believe, it's my long way of me saying, I have to believe the company's returns on invested capital are sustainable. That's a big part of the duration part of it as well. I have to believe they are sustainable. And the main way I get comfortable thinking returns on invested capital are sustainable is through high barriers to entry and multiple sources of overlapping moat that I think are durable and sustainable in nature.
Basically tying in the qualitative part to some of the quantitative math that you have to do when you're looking at a business's numbers.
Absolutely. Absolutely. Yeah.
Yeah.
Absolutely.
Love that.
And, you know, I mentioned a lot about duration and growth. And I think I mentioned PEs 1 or 2 times as well. So I invest across a spectrum of everything. So I invest across a spectrum of growth. I've got, like I said, some companies that I think can grow earnings per share 7 to 10%, and some that I think can grow earnings per share, 15 to 20% plus. And some are, I think, on the higher end of that, so 20%. So I invest across the growth spectrum. I invest across the PE spectrum. I've got some companies that trade at less than 10 times earnings. I wish I had more, but the market's not. I wish I had a lot more, but the market's just not giving me those opportunities, or else I'm not looking in the right places, one of the two. But I also have companies that trade at 25 to 30 times PE. So I try to invest across the spectrum.
Yeah, that's really awesome. Well, this has been such an awesome conversation. Appreciate all the knowledge and the backdrop about what's going on across the world, some of the places investors can look for exciting opportunities, and to get behind your process and how your brain thinks. I think there's definitely a lot we can learn from it. There's always going to be companies that are improving themselves in one way or the other. And if that turns into margin expansion as an example, that can be a big driver, as you know, and as you've taught today. So I know you're on Twitter. I follow you on there. If people want to check out what you got going on online, where should they go?
Thank you, Andrew. Yes, I'm on the Twitter, on the X at JRoGrow, JRO Grow. But preferably you check me out on our website, lastbastion.com, LASTBASTION.com. And you can subscribe to my newsletter, which is my baby. I love it. I write once a week right now. I put out a thought piece on valuation, which talks about 3 or 4 different ways that I think about valuation. Most of the pieces so far have been my earnings insights from Q4 earnings on 6 or 7 portfolio holdings. So it's a good way to find out some of the companies I'm invested in and how I approach maintenance coverage, because these are the notes that I would write for myself if I didn't have a newsletter, and this is what they look like. And then down the road in that newsletter, I'll also do some longer deep dive pieces, some more thought pieces, some more education pieces as well. And so you can subscribe at lastbastion.com.
Perfect. I will include that in the show notes, and I will be subscribing. I did not know you had that. I think Dave actually forwarded me one of yours. You did. It was a really good write-up. But
yeah, it was.
Thank you.
I have to go actually subscribe. So I will do that. Listeners, go do that as well. Dave, you're still here. Any last words from you?
Yeah, everything that John said was, of course, a masterclass as always, and he is well worth a follow. Not only on Twitter, but the emails that he sends out are very much like when I see him in my inbox, it's the first thing I read every time I see it. So it's worth your time for sure.
I really appreciate it. I work hard and closely with our head of marketing to get these out every week. I make it easy on people to read because so the first 3 or 4 paragraphs are my insight, my thoughts on the quarter, and I bold what I think is most important. So if you wanted to skim it, you could just read the bold parts. And then under that, I include what I think are the most important quotes from the earnings transcript. But once again, I bold there. And so you could almost like skim a transcript just reading my bolds. And then the third part is I include slides if they have a slide deck from the quarter. And I also highlight parts of the slides that stand out to me. And so for those that are interested, it's really a glimpse into what matters most to me based on the way I do things and based on the way I look at things, because I bold and highlight. And so, yeah, if anyone wanted to get into my investing brain, it's kind of a cool way to do that.
Yeah, it is. All right, folks. Well, with that, we'll go ahead and wrap up our show today. Thank everyone for joining us. Go out there and invest with a margin of safety, emphasis on safety. Have a great week, and we'll talk to you all next week.